What happens when the experts you trust to guide your investments are dead wrong? Again, when their rosy projections turn into financial nightmares, and instead of leading you to profit, they drive you right off a cliff. Today, in our Incompetence Court, we're putting 5 analysts on trial for their disastrous takes on ETSE stock, and they have a lot to answer for. And in this episode, we have a competence award for a special gem who actually did their job right. Normally, people don't get awards for the simple act of doing their job, but in this industry, that is actually a rarity, so it is warranted. One said ETSE was a strong buy at its peak, while another suggested it was just getting started. Each analyst, filled with misplaced confidence, cheered ETSE's rise, only to fumble when the company's stock took a nosedive. These aren't just bad predictions, they're textbook cases of arrogance, ignorance, and sheer incompetence. But here's the kicker. The signs of trouble were right in front of them, glaringly obvious to anyone willing to look. Today, we're dissecting their misguided analysis piece by piece. More importantly, we're going to reveal what these analysts should have been focusing on. If you've ever wondered how to avoid being led astray by so-called experts, today's lesson is one you can't afford to miss. If you're relying on analysts to steer your financial ship, let's just say you might be headed straight for a shipwreck. Stay with us as we expose the truth about ETSE, the lessons these analysts should have learned, and what you can do to protect your investments from their incompetence. Be sure to like, subscribe, and hit the notifications icon so you can be notified accordingly. And stay tuned until the end for a deep dive on ETSE, what went wrong, and how you can use this information to be a better investor. The 5 analysts we are about to mention completely botched history on this one. But as we are committed to accountability for competence on Wall Street, it is imperative that we give competence credit where credit is due. Lauren Cassel of JPMC wins the Competence Award for the day. As you can see, she was correctly bearish the whole time, warning investors with sell calls on the climb, and reiterating as the stock tanked. She switched to neutral in the trenches, which is understandable as it had a huge down run. She then did the homework needed to understand that the stock is still a sell, which she then called and holds that call to this day. Her price estimates did play chase with the stock somewhat, which we don't like, but she gets a pass on that because, as we can all see, she made the bold move to still undershoot and call sell when it needed to be called. If you had listened to her, you may have made some money if you like to short, and you definitely would not have lost any money. Good work, Lauren. We need more people like you in this world. Our other analysts today do not have any awards in sight. There were some variations in their patterns, but 2 major consistencies. 1, they mostly touted the stock on the way up and down, only to go neutral in the trenches flipping after all the damage was done, and 2, they got it completely wrong. Nicholas Jones of JMP began his coverage of ETSE in early 2019. He touted the stock as a buy all the way up on its bull run conservative with the actual price targets until when he made a bold 320 overbid buy call in December 2021. But unfortunately for him, this was after the peak, and the stock tanked after that. He held on to that ridiculous call until the trench of the sell-off, where he simply lowered his bid to again an overbid of 125 and maintained outperform. Nick, really? After all that you are still overbidding and telling people to buy? Then, in October 2020, Nick had a bipolar decision change to neutral that match chased the price almost exactly. This is criminally incompetent, guilty as charged. Nick's co-defendant, Marvin Fong, is being charged with gross incompetence. These analysts, working in tandem, managed to bungle their takes on ETSE so spectacularly that it's almost as if they conspired to mislead investors together. Marvin is also being charged with trying to mislead investigators on the case. As you can see, Marvin tried to mislead investigators by making conservative price targets, in comparison to his accomplice Nick. But we can see on the chart that Marvin indeed held the weapon in this case and pulled the trigger. He called buy neutral before the climb and never even switched for a second to neutral after the crash. Absolutely egregious. He touted the stock all the way up and down, playing a game of chase with the price and telling investors to buy the whole way. To this day, he maintains a buy call. Marvin is guilty of 2 counts: incompetence and attempting to mislead investigators, sentenced to a life of number crunching at his nearest investment bank. Our next defendant, Edward Yaruma of Piper Sandler, was also grossly incompetent. He had a more conservative price target at and around the peak, but followed the same pattern of touting on the way up and down, Only he changed to neutral in the trench and held that to this day, guilty of incompetence and attempting to mislead investigators. Anna Andreeva of Needham started in on this party a little later than the rest, but she wasted no time and quickly climbed the incompetence ladder by overbidding and initiating buy calls on the little bull climb that was left during the free fall and even deep in the trenches. In fact, it wasn't until August of 2024 that she had a change of heart and went neutral. Where do they find these people? Oh, they find them at top-tier universities. Are you looking for a way to make money that doesn't involve going into $500,000 in unmanageable debt? Consider starting your own YouTube channel. With Tube Magic by Matt Parr, you'll get all the tools and knowledge you need to start, optimize, and grow your channel into a profitable venture. Matt's course offers proven strategies from years of experience in running successful niche channels and helping students achieve financial independence. Click the link in the description to get started with Tube Magic today. Our final defendant for the day, Naved Khan, is guilty as charged for incompetence on all counts. Naved played a game of chase with the stock price on his estimates while telling investors to buy the whole way up, the whole way down, and the entire way to this day. No more questions, Your Honor. I rest my case. As we put these so-called experts on trial today, it's clear their failure goes beyond just poor predictions. It's a fundamental misunderstanding of the company they were supposed to be analyzing. But before we dive into the staggering incompetence on display, let's take a step back and get a clear view of what they missed. Disclaimer: incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. What is Etsy, really? How did this once thriving marketplace go from a growth darling to a stock in freefall? To truly understand their blunders, we first need to unpack the company's background, its meteoric rise, and the underlying challenges that sent it crashing down. Etsy, founded in 2005, started as an online marketplace for handcrafted and vintage goods, quickly growing into a platform that empowered small business owners and artisans to sell their unique products to a global audience. The company capitalized on the rise of e-commerce and the growing demand for personalized, sustainable, and one-of-a-kind products. Etsy became the go-to platform for consumers seeking alternatives to mass-produced goods, and the company's stock soared as it gained momentum, peaking in late 2021 as the COVID-19 pandemic pushed even more shoppers online. But beneath Etsy's rapid growth lay several fundamental issues that analysts failed to recognize or chose to overlook. As the pandemic waned, consumer demand shifted back to traditional retailers, and Etsy's customer base shrank. The company's heavy reliance on its marketplace sellers also exposed it to vulnerabilities, as rising fees and shipping costs made it difficult for many vendors to maintain their businesses. While Etsy diversified its offerings, including acquisitions like Reverb and Depop, it struggled to maintain its growth trajectory. Financials began to crack, with revenue growth slowing and profitability pressured by higher marketing expenses and operational costs. Etsy's fundamentals were further weakened by an overvaluation fueled by pandemic-driven e-commerce hype. The company's price-to-earnings ratio soared to unsustainable levels, driven by over-enthusiastic investors and analysts alike. As inflation concerns, supply chain disruptions, and post-pandemic consumer habits took hold, Etsy's stock took a nosedive, falling over 75% from its highs. What was once seen as a high-growth darling became a cautionary tale for relying too heavily on inflated expectations. Analysts missed the signals, failing to adjust their ratings in time, leading to massive losses for investors who were left holding the bag. As we reflect on the fiasco surrounding Etsy's stock analysis, two crucial lessons emerge for investors seeking to navigate similar pitfalls. One significant takeaway is the importance of understanding a company's true value through a thorough analysis of its price-to-earnings ratio and overall earnings health. Analysts failed to accurately gauge Etsy's valuation, which led to misguided investment recommendations. During the pandemic, Etsy's stock was driven up by heightened e-commerce demand, resulting in an unsustainable PE ratio. This overvaluation was not adjusted in time as the company's growth trajectory slowed, exposing the stock to a dramatic fall. Investors should be cautious of high PE ratios, which can often signal overvaluation, especially when driven by speculative hype rather than solid financial performance. Another lesson is the need to account for external factors, such as the impact of COVID-19 on consumer behavior and supply chains. Etsy's rapid growth was significantly influenced by pandemic-driven shifts in shopping habits, but as the world returned to pre-pandemic norms, the company struggled to maintain its momentum. Understanding these external influences and their potential to alter market dynamics can help investors make more informed decisions and avoid the pitfalls of relying solely on short-term trends. As we conclude our examination of the disastrous analyses surrounding Etsy's stock, it's evident that a deep understanding of a company's fundamentals, combined with an awareness of external economic factors, is crucial for making informed investment decisions. The failure to recognize Etsy's overvaluation and the shifting market conditions highlights the risks of relying on overly optimistic projections without a grounded analysis of financial metrics and broader trends. The lessons from this case serve as a reminder of the importance of vigilance and critical evaluation in the ever-changing world of investing. Feel free to check out this video for another entertaining but sad case of analysts botching history. They did so with GL stock.